Hello, and welcome to another episode of The Wealth Alchemist. Today, our hosts will be Shane Keith and Dylan Justice from the Investment Committee here at KDI Wealth Management. And they'll be speaking with Kara Murphy, the Chief Investment Officer from Kestra Financial.
Kara, can you give us a little bit of your background, introduce yourself, and maybe a quick overview of Kim and your team?
Yeah, absolutely. And if you don't mind, I might go back a little bit further than what I normally would. But I do like to share with people that I grew up the daughter of two English teachers. So often at the dinner table, we would quote poetry, we would act out plays, but we wouldn't talk anything about finance. But as I was heading off to college, my parents ran into some serious financial trouble, such that, every semester I would go back to college and not know if I was going to be able to go back again. So I learned fairly early in life the consequences of making bad decisions, but I also didn't have really great tools to make good financial decisions. So roll forward, I ended up working on Wall Street, really by accident, and sounds a little silly to say that, but I never saw myself in that kind of Wall Street mode. But once I got there, I found out, much to my surprise, that I loved doing what I did. So I loved, the constant puzzle that the market offered. Every day, literally something different, real intellectual challenge, very dynamic. I loved all that piece of it, and it was exciting. But after a number of years, I would have a great day in the market, right? And I was like, oh, I made a couple $1 million for our clients, but it was like a number on a spreadsheet, so it felt good, but not great. But over time, as I worked more and more with financial advisors such as yourselves and your clients, it was suddenly like this light bulb went off where I was like, oh, I'm helping people make good financial decisions, send their kids to college, buy that lake house so they can hang out with their grandkids, and being able to bring that meaning into what is otherwise, a very abstract thing has been incredibly meaningful. And I love that. And I take it like a great responsibility in sort of thinking about the investment decisions that we make. And I'm incredibly grateful that, people are willing to trust us to be able to make those decisions.
That's wonderful. In regards to, so it sounds like a ton of personal motivation of why you got into finance, and I can actually go into a very similar story, at least what motivated me to go down the financial path, and why I sit in the seat I sit in today, getting to help people provide themselves and their families stability and growth from a financial perspective. So I love hearing that. Thanks for sharing.
I love it.
Why is it beneficial, or what would you say, to have firms like ours partner with a dedicated investment management team like yours?
So, at Kestra Investment Management, which we often call Kim, I'm not called Kim, although you can call me whatever you want. But at Kim, I like to say we have 14 investment professionals who love to geek out on the markets, right? We wake up every morning, we want to find out what's happening in markets, we want to think about portfolios. And that's all we do, and we love it. And so that is, we're able to bring all that brain power and that time and that dedication together in a way that, sometimes can be very hard for a financial advisor who's trying to juggle a lot of different things, right? You guys have deep expertise in things like financial planning. We can sort of take that and marry it with certain investment decisions and come up with something that's really just right for your particular client.
Dylan, you want to take the next question?
Yeah, I'd say that we have our investment principles here at KDI, and one of those is we like to plan to goal for clients, and whether that be retirement, whether that be a new car, a new house, whatever their goal may be, that's what we like to plan to. What investment principles do you employ there at Kim that guide your decision-making process when you choose what to put into your portfolios?
I think that idea of investing to plan is so important. And I want to make a little bit of a distinction, because in the investment world, that's not always the case. And I spent much of my career early on as a stock picker. And, I spent a lot of time sort of talking to CEOs and listening to earnings and building earnings models and whatnot. And I would think about what stocks I thought were going to go up over time, but I would never think about how does that stock lead to a good outcome for an individual, right? And often, you know, as just an investment person who's not in the wealth management context, you can do that. But then I realized how important it was to sort of think about that last mile, right, into an individual's actual goals. And so, you know, the most obvious one there is risk. So what's the path going to be of those investment returns as we get closer to an individual's goal? Now, we can't tell you what the market's going to do tomorrow, but in general, the longer the time horizon that we have, the more risk we can take, because we can take a little bit more time and we can manage through those downturns where we need to. But sort of like thinking about that becomes a very important component of how we put different asset classes together to make sure that we're arriving at that destination in time.
My next question actually is asking about your crystal ball of markets and
I usually have one on my desk. Oh yeah, here it is. Look at this. I actually have a little crystal ball.
there we
No,
go.
it doesn't work very well.
What are some of the biggest market themes or trends you're watching right now?
There are a lot, right? I mentioned earlier that I love the fact that the market is really dynamic, but it's one of those things like careful what you wish for, right? Because there's always a lot of stuff that's very interesting and very important for the markets. So a couple of things that we're very focused on right now. One is, you know, your clients have probably heard a lot about the Magnificent Seven. That's been all the rage for the last 2 years, and for good reason. These are 7 of the largest companies in the market that have also performed the best over the last 2 years. So that's great, right? And if you own a diversified portfolio, you have exposure to these names and you have benefited from the fact that these names have gone up. That said, the consequence of that like great outperformance of the Magnificent Seven is that benchmarks and portfolios are very heavily tilted towards those names. So we want to make sure that we're thinking about risk and starting to pull some of those portfolios a little bit back towards center to make sure that we're not too overweight those names, right? Diversification is always one of those things that we take very seriously and we really want to see represented in a portfolio. That provides that easier ride. So that's one thing in terms of like reacting to what's happening in the market. One other thing that I would note that, you know, we're getting a lot of questions about is policy. So with a new administration in, there are a lot of policy changes that we're having to pay attention to. Tariffs kind of top of mind, right? The headlines are very focused on any new tariff that's coming out. So we're looking at each of those, trying to understand what the impact is on the US economy, global economy, individual names, industries, all that kind of stuff. What I will say though is that, you know, given the sort of like big shift in a lot of different policy areas of the new administration, there's a higher level of uncertainty about how many things will go through. That said, you know, we think ultimately the market moves depending on how much American companies can earn over time, right? And that's always going to be the most important driver of the market at the end of the day.
You mentioned the Mag 7, and you know, from one analyst to another, it seems like in the market right now, there's a lot of comparisons between the late 90s, early 2000s, from a tech perspective and what we're seeing today. Where would you draw a delineation between the two?
You know, it's such a good question because we have this conversation a lot, right? And internally with the investment team, like, is this the 1990s? If it's the 1990s, is it 94 or 99, right? Because that makes a big difference too. Yeah. And I actually started in this business almost to the day that the NASDAQ peaked in 2000. So my first couple of years on the market, we're just watching those technology stocks go down. And it really didn't feel great at the time, but in retrospect, of course, it's a great time to really learn. Yeah. So it's something that we think about a lot. So a couple of similar themes. One is, as you mentioned, both those time periods, you saw technology companies really soar. And you also had new technology coming out that was truly transformational, right? Back in the late 1990s, it was the internet. The internet has changed how we shop, how we communicate, how we do research. I mean, all these things have hugely changed because of the internet. But what was interesting is that in 2000, you couldn't necessarily predict which companies were going to be the ones that were going to benefit going forward, right? So we had a lot of names that were household names at that time that went out of business and then not long afterwards. So similarly, today we have this hugely transformative technology, artificial intelligence largely. We have other big technologies that are happening too. Think like cloud computing and 5G and those sorts of things. But AI has really gotten the focus. And I have no doubt that my 3 kids, when they are in the workforce, what they do on a daily basis will be heavily impacted by artificial intelligence. I've no doubt about that. But can I predict exactly which companies are around today that are going to be the ones to transform things in the future? That's a lot harder, right? So I think those 2 parallels really hold true. What's a little bit different today versus back then is that these companies that we're talking about today, many of whom are in the Mag 7, have real earnings to show for what they're doing. That's a big difference, right? Back in 2000 when we were talking about like eyeballs. Do you guys even remember that? Like, no, like what's that mean? Like how many people were going to your website? That was a measure that actually drove stocks back in 2000. So the good news is that, a lot of the strength in the Mag 7 reflects like actual strong earnings growth. That's a bit of a double-edged sword because then going forward, those stocks will react to future earnings growth, right? So they have to continue that earnings growth in order to have that strong future performance.
And Kara, with that and AI, do you think that will increase the productivity across the rest of really the market and companies?
And this is another one that we think about a lot. And I've seen a lot of economists try to like put numbers on it, like how big is this productivity miracle going to be? So I think that the short answer is yes. The harder question is by how much, right? And I even think about some things that I do, like when I'm doing research on a topic that I don't typically research. I use ChatGPT to like at least get me in the right direction, and then it sends me the links where I can verify, and so it just really shortens that path for research. And there are a lot of other kind of repetitive tasks like that AI is surely going to make more productive. So I think what's harder is sort of determining like how do we actually put a number on that? And what we found in the internet is that it did make a lot of things much more efficient, but also it sometimes just shifted things from one bucket to another. So think about like shopping. In 2000, e-commerce was not a thing. Now, e-commerce makes up a huge percentage of purchases. So we've certainly moved our purchasing from one place to another. Have we become more productive in how we shop and how retailers serve goods? Yeah, I think they have. But it's definitely been an evolution and not something that changes just at one moment.
And I'll just ask this question a little bit off the cuff. When we were out at a national conference, you mentioned, or you delineated between growth and value and what you were seeing in the markets. And I would say in the last decade, and even for sure the last 5 years, lots of clients have been like, well, what about the S&P? What about the S&P? What about the S&P? What would you say to defend a diversified portfolio?
I've been in the market for a while and I have seen a lot of periods where I was very grateful I had a diversified portfolio. And we've already talked about one of them, right? In 2000, there were a lot of people who owned just .com companies that ended up going bankrupt in the not too distant future. And actually, I will share a quick anecdote on why a good lesson on why you should think about diversification. So I worked at Morgan Stanley in 2000 in their investment management division. And at the time, we had 4 different mutual funds that were focused on technology. They covered mostly the same stocks. Each one had a totally separate team of analysts and portfolio managers. From the peak to the trough, those 4 mutual funds collectively lost over 95% of their market value. Those are 4 different teams having different conversations, having different earnings models, right? Different viewpoints, and all of them went down by over 95%. And it wasn't because they weren't smart, and it wasn't because they weren't working hard, right? They were just in that space that got walloped. And from that point, from 2000 for the next 15 years, the NASDAQ did not regain its high. Right? It's so easy to forget that today, but it was 15 years before it got back to that previous high. That was a time when value stocks, so stocks that, are a little more beaten up, don't have high valuations, maybe not as fun, exciting stories, but it was those types of stocks that actually did really well during that time period.
Thank you for that.
Separately, what are your thoughts on crypto and commodities? We hear a lot about Bitcoin, Ethereum, gold, especially with some of our clients. And what are some of your general thoughts there? And if so, do you think you should own gold and silver as a part of your portfolio? And should that be physically, can you hold and touch this, or should you own it in terms of an ETF or electronically?
So I get tons of questions lately about crypto and then different types of commodities. So it's an area that we've spent a fair amount of time thinking about because our clients are thinking about it. And I'll take those two in a couple of different buckets. One is, let's talk about commodities, because those are ones that have been around for a really long time. And specifically things like gold and silver. So we'll call those precious metals, which are part of the commodities complex. The short version is that we don't think that gold and silver are good strategic asset classes. So what does that mean? We don't think that they should have a place in a portfolio that you're holding for over a long time period to grow your wealth. The reason is because we have like a couple hundred years worth of data to sort of see how different asset classes perform. And gold actually has not been a reliable builder of wealth over time. There tend to be really short periods where it outperforms, and then it'll do nothing for a few decades. And a lot of people like to think of it as this very defensive store of value. And in public markets, it hasn't performed that way really well. In other sort of instances, it has. And I'll give an example. So my in-laws are from Germany. My father-in-law escaped East Germany in the wake of World War II. In his pocket, he had a few gold coins to help get him through when he got to the other side. When each of my kids was born, he would present us with 2 gold coins and he would show it to us, and then they would go right back in the safe where they are today. Gold for him was this great store of value in really, really scary times, and it had to be portable, right? He had to take it with him. So for him, he sleeps easier at night knowing that there are a couple of gold coins for each of my kids. And that makes a lot of sense to me. But as we think about a portfolio where we have access to all these different asset classes, gold really hasn't done a great job as being a store of value. Now similar, like Bitcoin is sort of like an interesting twist on all of that, where how do we value it? It doesn't really do anything. There's not earnings associated with it. There's just not a dividend associated with Bitcoin. So we did an exercise sort of looking at Bitcoin as if it were a traditional asset class, like stocks or bonds.
Yeah.
And what you find is that Bitcoin, yes, has gone up a lot, but there have also been periods where it's gone down a lot. So it's very, very volatile, much more so than like a stock or bond. And that for us is like this constant sort of weighing that we do. How much is this asset class going to grow, but how much is it going to move around in the meantime? And so if you simply compare that level of volatility in Bitcoin versus things like stocks and bonds, it's like off the charts. So if you balance that, what it means is that you need to keep if you want to have exposure to Bitcoin, you need to keep it really small as a portion of your portfolio, because even at that small level, it's going to have an impact on your portfolio, moving it day to day. Now, I don't think in order to grow wealth reliably over time, you have to have access to crypto. But if you really want access to crypto, just keep it small, right? You don't want it to overwhelm all these other traditional asset classes that you have.
Thank you for that.
It might be more than you'd hope for.
That was great. That was great.
That's awesome.
With all the uncertainty that investors are navigating in the markets today, what's one piece of advice you'd give to investors as they move through, let's say, the next 12 to 18 months?
So my advice on this has changed a little bit. These days, it's turn off your TV and get off social media.
I love that.
And I mean, I say that lightly, but the reason is because there is so much information that is being pumped out there that is highly emotional and not impactful for your investments, right? And it is very hard to divorce yourself from that. And investing has a lot of emotion in it. Like, we're talking about our money and our future and our financial decisions, right? Like, it's understandable that we have a lot of emotions, when we see our portfolios go up and down. But when we think about most of the headlines that are coming across our desk on a daily basis, they're really not going to have an impact on our portfolios when we look out like a year, 3 years, 5 years, right? And that's typically the time horizon that we have with our clients. So just make sure that you're doing what you can to kind of take that emotion out of it, to allow you to think about what are the things that are really impactful for the things that I own.
How does your team research and select investments, and what's your overall methodology? What sets it apart?
Yeah, so we thought about this a lot at the very beginning as we were sort of putting our team together years ago to make sure that we were very much aligned, because there are different ways to approach investing. But what was great is that as we assembled the team, there were these themes and these things that we all sort of agreed on that are really important. And those things sort of under all of the different strategies that we have. So one is being independent. It's really important that we are able to look out across the industry and identify those managers, those funds, those asset classes that we think are going to suit our clients best and work best in our portfolios. And being able to do that gives us a great advantage in not being stuck in anything that we don't feel great about. So we do a ton of due diligence on everything that we own. Another important thing, and this I think is not terribly common, is that we have a bias towards simplicity. And the idea is that, our business has a lot of really smart people who can be very tempted to complexify things. And adding complexity is not always in the best interest of our end clients. A lot of times, the simpler approach is actually the better one. That doesn't mean we never add complexity. It just means that we have to have a very high degree of certainty that anytime we add complexity, we know why we're doing it. And we really believe is in the client's best interest. The same is true for cost. Right? That is one lever that we can control, and wherever we can save on costs, we're able to pass that along to the client so that they have better returns. So again, it doesn't mean that we never add something that's higher costs, but we have to really believe that it's going to add something to the portfolio. And then I'll say the last one is about being risk aware. And making sure that, we talked about this earlier, making sure that these investment decisions that we make sort of fit within a client's end goal. And that's really a lot about managing risk and making sure that we're sort of creating that path that makes sense for the individual client. And I'll just add there, like one of our core kind of values that we manage to both as investors and as teammates is humility. And I think this is something that you don't hear enough about in investments, but I think as an investor is incredibly important. We need to be humble about the fact that we're always dealing with limited information. We can always be wrong. We just need to recognize it quickly and pivot, right? And so we try to foster this atmosphere where everybody's very comfortable challenging each other in a respectful way so that we can understand when there are things that we either got wrong or that we don't know. And that allows us to manage risk appropriately.
Awesome. Thank you for everything, Kara.
Oh my
Really do
goodness. Thank
appreciate
you
it.
guys.
Thanks for your
Yeah,
time.
thank you. Thanks.
Okay.